In capital budgeting, companies would usually evaluate if they have real options with relation to the projects that they are undertaking. So in this video, we're going to look at the abandonment option, where the company has the right to actually abandon a project upon commencement. Okay, so maybe 1 year later or 2 years into the project, the company may want to abandon it if, let's say, the demand is low, okay, and they are generating very low cash flows from this project. So they may want to abandon it, or of course, they can choose to continue with the project. So what we want to evaluate here is what is the NPV of the project without the real option, which means that the company is not able to abandon the project. And then we'll consider what if the company has the ability to abandon the project. Then what would this do to the NPV of the project? So in this example, we will consider a project where the initial outlay is $500,000 and the project has a life of 6 years. Now, there is a 50% probability that the annual after-tax operating cash flow would be $80,000. Okay, if let's say demand is low, or in this case low cash flow, and there is a 50% probability that the after-tax cash flow will be $140,000 per year. We'll assume that at the end of year 6, the salvage value will be equals to 0. The required rate of return is 12%. And now we'll consider that at the end of year 1, upon realizing the cash flow, the company will have an option to abandon the project and receive a salvage value of $400,000. So this is only in year 1. So this is an example of an abandonment option that we will consider in our computation shortly. So we will break this example into 2 parts. In part 1, we will compute the NPV of the project, assuming that the company has no option to abandon. In the second part, we will compute the NPV of the project, assuming that the company has the option to abandon it in year 1. Now, if there is no option to abandon, of course, we'll consider that there are 2 scenarios here. There is a 50% probability that the cash flow is low. So we'll have a series of $80,000 of annual after-tax operating cash flow for the 6 years. And then there is another 50% probability where the cash flow is high. So the annual cash flow is $140,000. Now we will compute the NPV for these 2 scenarios where the cash flow is low and when the cash flow is high. And then after that, we will take the average, okay, or the expected NPV using the probability of 50% given in this example. Now, when we compute the NPV of this, for the first scenario, you can use the financial calculator or you can use your formula. And in this case, this is an annuity. So of course, we could just take negative 500,000 plus 80,000 over the required return of 12%. Multiplied by 1 minus 1 over 1.12 to the power of 6. Okay, you can use the formula if you want to, or you can use the financial calculator. Now, using the financial calculator, you will press the cash flow worksheet, and then our CFO here will be 500, and that's negative. I will leave out the thousands. Okay, so I'll just take 500 here, and then for CO1, that's 80,000, so that's 80. And then the frequency here is for 6 years. So I'll enter 6 here and press enter. So we have all the cash flows, and then go over to NPV. Your I is equals to 12 here. Enter again. Scroll down and press compute. So the NPV of the project is negative 171,000, okay, 0.09. So let me just state it down here. So that's negative 171.09 thousand. All right, now what happens if the cash flow is high? So again, we can use the formula where we take negative 500,000 plus 140,000 over 0.12 multiplied by 1 minus 1 over 1.12 to the power of 6. Okay, or we can use the financial calculator. And in the financial calculator, we'll move back to the cash flow worksheet and change the cash flow to 140. And then we'll compute the NPV again, so that's 75.6 thousand. If I round it to 2 decimal places, so that's a positive 75.6 thousand. Alright, so here we have a negative NPV under the low cash flow scenario, and we have a positive NPV under the high cash flow scenario. And finally, the NPV of the project will be the weighted average based on the probability. So that's 50% multiplied by negative 171,000, okay, 0.09, and then plus 50% of 75.06. So that gives a negative 47,000 and 750,000. Okay, so that is the NPV of the project, which is negative. So in this case, a negative NPV means we will reject. Okay, we will reject the project. So that's a decision, assuming that there is no real option or the option to abandon in this case. Now, another way to do this question, okay, is to just take the expected cash flow for the two scenarios. That means we could have just taken 50% multiplied by 80,000, okay, under the low cash flow scenario, and 50% under the high cash flow scenario. So that will give us an expected cash flow of 110,000 each year. So we could have just taken negative 500,000 plus 110,000 here over 0.12 multiplied by 1 minus 1 over 1.12 to the power 6. So that will also give us negative 47.75 thousand. Okay, so we could have obtained it this way as well. But I just wanted to show you the NPVs under the two different scenarios. Now, moving over to the next part where we now assume that the company has the ability to abandon the project in year one once they realize the cash flow. And if they choose to abandon the project in year one, they will be able to obtain a salvage value of 400,000 on top of the cash flow in year one. So again, we'll assume that, okay, there is a low cash flow, 50% probability, and the company chooses to abandon in year one. So the timeline will now look like this, where the company will receive 80,000 in year one, and then they will close and abandon the project and get 400,000 in salvage value. And there can also be a high cash flow scenario, but they choose to abandon it in year one. So the timeline will be, in year one will be 140,000 plus the salvage value of 400,000. Now we're going to calculate the NPV of these two scenarios, and we will then compare it to what we computed previously, which is the scenario where the company chooses to continue with the project, okay, regardless of the cash flow. So earlier we computed that if the company were to continue with the project under a low cash flow scenario, the NPV would be negative 171,000, okay, and if it's a high cash flow, then the NPV would be 75,000, okay, or 75.6 thousand. So what we want to do now is we're going to calculate what is the NPV if we choose to abandon the project. So for the first part, if the cash flow is low, okay, we abandon, so the NPV will be negative 500,000 plus 80,000 plus 400 is 480,000 divided by 1.12 to the power 1. So that will give us negative 71.43 thousand. So if you compare the two NPVs, if you continue, the NPV will be larger, negative number. Okay, but if you abandon it, then it will be a lower negative number. So between these two here, the abandoning strategy would be more optimal. Okay, so this would be the optimal strategy that we will select in this case. If the cash flow is low, the company will choose to abandon rather than continue, because that will minimize the negative NPV. Now for the high cash flow scenario, if they choose to abandon, then the NPV would be negative 500,000 plus 540,000 divided by 1.12 to the power of 1. So that would be negative 17.86 thousand. So between 75.6 thousand and a negative NPV, we will definitely go for the positive NPV. So we now come to a decision that if the cash flow is low, then the company will abandon the project in year one. But if the cash flow is high, then the company will choose to continue with the project. So these are the two paths that we have chosen. So the NPV of the project would then be 50% multiplied by the NPV of the low cash flow, but we abandon. So that's negative 71.43 thousand plus 50% of the NPV of the project if we continue with it under a high cash flow scenario. So there's 75.6 thousand. So that would give us an expected NPV of 2.09 thousand. So with this, the NPV is now positive. Therefore, the company should accept the project. So with the real option, the NPV of the project can actually go from negative to positive, as we have seen, okay, in the first part, where the NPV is actually negative 48,000 if there is no option to abandon. Okay, but with the option to abandon, the NPV changes to positive 2.09 thousand. So that's it for this video on the role of real options in capital budgeting. So there are different type of options, and this is just one of the many real options that are available for businesses.